Good evening, everyone. Time for another silver update. You are looking at the weekly chart provided by Netdania.com. You click on the link below. I've drawn a number of trend lines on this chart. We're trying to take a fairly long-term view. The first thing I want to look at is the MACD down here. And you can see we were rounding up. If we zoom in, let me pull off the freehand lines so that I can control the chart. If we zoom in, you can see that we were rounding up on the MACD when we got this most recent smackdown here, and now we're rounding up again. We're looking for this cross, and we're expecting some kind of significant price move when we get this cross action in the MACD. Now, these trend lines that I've drawn, this upper channel trend line has been in place since the spike top that we had in early 2004. We spiked up to it 2006, again in 2008, and then we touched on it in late 2010, early 2011. We penetrated it to the upside. So the active trend channel, of course, is this channel right here, and you can see we're at the upper band of this trend channel. Now, I've drawn in this lower trend channel as a parallel because in the 2008 smackdown we actually dropped out of the channel and formed a new one, a new lower one, and then we came back up. We may even be forming a higher one here, but we don't have enough information to see that at this point. So we want to look and examine how the price reacted in the light of this trend channel. Now you can see where the price is trading right now at about 32.5. We're starting to rally a little bit, but one of the main things I wanted to point out is that with this correction that we had here, what we would have expected under traditional support and resistance analysis, we would have expected a correction back to this line here. But you can see that we actually got a correction just to the edge of this trend channel, and as I said, this trend channel has been in place for quite some time. Now the bottom part of the trend channel really didn't form. You could probably draw it out farther, but really didn't start forming until about 2007. So this is the primary channel. Now the question is when we round up here on the MACD and we actually get a crossover to the upside, is a new trend channel going to form? My guess is that it probably will, and we'll probably be looking at something like a trend channel of, say, roughly parallel to where we are here. We will begin to be testing within this range up and down until we can get a breakout above this high. So those are the price points we're looking for. I think that this test of the bottom line of the trend channel is pretty firm. We seem to be rallying strongly out of it, and of course with this crossover expected in the MACD, we should get a break into a new potential trend channel moving forward, ultimately taking us to new highs. Now that's just speculation at this point. And on that topic, I wanted to go over to the latest article. It is James Turk talking about he's expecting a violent move higher, especially in silver. So let's jump into this article. While the silver price moves higher with the gold price during the latest consolidation phase in the bull market for precious metals, Gold Money's James Turk expects another violent move higher for the metals, especially the price of silver. Quote, "This move in the silver price is going to catch a lot of people by surprise, as evidenced by the extremely low sentiment readings," Turk told King World News Monday, pointing to the lack of overall enthusiasm in the precious metals market of late, with a relatively steep contango in the silver futures market chain serving to support his thesis. Quote, "These low readings are clear indication that there's a lot of money on the sidelines that is waiting to jump on board." And then there's a link for the alert. Now, I wanted to take a look real quick at Contango and backwardation because these are some things that people don't understand. Hopefully I can clarify these. So let's start off with the definition of Contango. And this is just a standard Wikipedia article. Contango is the market condition wherein the price of a forward or futures contract is trading above the expected spot price at contract maturity. The resulting futures or forward curve would typically be upward sloping, i.e. normal. Since contracts for further dates would typically trade at even higher prices, the curves in question plot market prices for various contracts at different maturities. A contango is normal for a non-perishable commodity that has a cost of carry, such as the cost of warehousing fees or interest foregone on money tied up, less income from leasing out of the commodity if possible. For perishable commodities, price differences between near and far delivery are not a contango. Different delivery dates are in effect an entirely different commodity in this case. So, and they give the example of fresh eggs. So, when you're talking about the precious metals, you're talking about a non-perishable commodity, and a contango situation is the normal state of affairs. We're going to look at the forward futures for silver, but first, before we do that, we want to look at backwardation, because that's the other state of a market. Now, normal backwardation, also sometimes called backwardation, is the market condition wherein the price of a forward or futures contract is trading below the expected spot price at contract maturity. The resulting futures or forward curve would typically be downward sloping, since contracts for further dates would typically trade at even lower prices. The curves in question plot market prices for various contracts at different maturities. The opposite market condition to normal backwardation is known as contango. A backwardation starts when the difference between the forward price and the spot price is less than the cost of carry, or when there can be no delivery arbitrage because the asset is not currently available for purchase. Futures contract prices include compensation for risk transferred from the asset holder. This makes the actual price on expiry to be lower than the futures contract price. Backwardation very seldom arises in money commodities like gold or silver. In the early 80s, there was a one-day backwardation in silver, while some metal was physically moved from the COMEX to the CBOT. Gold has historically been positive, with exception for momentary backwardations. The term applies to forward prices other than the futures contract, etc. Now, they do mention that in 2009 that there was backwardation. Notable examples of backwardation include copper, circa 1990, arising from the market manipulation of Sumitomo Corporation. And this is quite interesting here. They list silver, and they say in 2009 has been in backwardation since late January. This is due to suspected long-term price suppression as cited by Ted Butler. Now that's very interesting. You've got Ted Butler being cited in a Wikipedia article about the backwardation in silver. So let's jump over to our silver contracts. This is the CME group, of course, and that's going to be the primary place to look at the metals here in America. So we want to go to the metals, and then we want to click on silver, and this is going to show you the months out. So these are the active contracts in silver. Each commodity has various delivery months that are active. Some of them are primary months, such as December is a key month. February can sometimes not be a key month. I think the key months are December, March, September. I'm not sure if it was June or July. Actually, July, September, and December again. So you got 4 or 5 key months, and the others, they trade, but they don't trade a lot of volume. So just to look at the state of backwardation or contango for silver right now, it's real easy to calculate. You just take the prices, and we're going to look at the last, of course, but you might want to look at the prior settle because we don't have data further out than July of 2012 for this. So you can see just on the last, we've got 3250, 32.57, 32.6, 32.5, 32.7, 32.7, then we come down here 0.8, 0.8, and then it kind of falls off here. So we have a sort of contango going here, and this is what James Turk cited. Now it's not really a strong contango because it kind of falls off here back down to lower prices in the further out years, which is a little bit strange. So let's look at gold so we can do a comparison. And when we look at gold, you can see that we go 17, 27, 29, 31, 34, 37, 39, 42, etc. A straight contango situation. So the idea is that the cost of carry and the interest costs foregone cause that price to be higher in these futures. Now, the question is when and why do you get backwardation, since the normal state of affairs is for it to be in contango. Now, if we go back and look at the commodity that I found that is showing some interesting pattern, is actually the energy complex and the I believe it's a light sweet crude. So if we take a look at light sweet crude, we can see that we'll go by the prior settle. We can see that we're going down to December 2012's 99, and we're at 101.47. So we go up a little bit and then we go down. This is the closest we have to backwardation right now. Now, what does backwardation mean? When the prices are higher in the forward month, the closest month out, when those prices are higher than the prices going further out in time, that means it's in a state of backwardation, and what that means is that people are paying a premium for delivery now. What that indicates is that there are some reasonable doubts as to whether or not delivery will be made in a timely way, or if something will intervene and change the market in the future. So, as I pointed out, silver was in backwardation in 2009. Silver's currently in a state of contango, but these are the types of scenarios we want to watch, especially when we see backwardation pop up. Backwardation in silver means that there are very strong doubts as to whether delivery will occur out into the future, and they basically hint at a potential default. Extreme backwardation in silver or gold indicates that a physical default may actually occur. And that's why the current settlement is actually trading at a premium to the future, because people would rather get their hands on the metal now as opposed to later. So hopefully that explains a little bit how backwardation and contango work relative to each other. Let's go back to the James Turk article. Such low sentiment readings and steep contango prices in the silver futures haven't been seen since the first quarter of 2010, when problems in the Greek sovereign debt market first emerged. At that time, fears of another Lehman event, this time from Europe, took the Dow Jones Industrial Average sharply lower from its intermediate post-crash peak of 11,250 down to 9,600. A nearly 15% correction in 30 industrials. In contrast, after trading between $15 and $18 range during a 9-month period of September 2009 and June 2010, the silver price climbed higher in the face of a risk-off than risk-on trade in stocks of 2010, as the white metal never looked back, soaring to just shy of $50 from the $15 base as a previous flagpole pattern. The tremendous rally in the silver price took Wall Street by surprise, as any asset rising this rapidly typically begets a much wider audience beyond the silver bug watchers. That contrarian signal suggested to legendary commodities investor Jim Rogers that the silver price would need to settle down before he became a buyer again. The weak hands had taken over the silver market. Now, if you remember, back in May, prior to the May silver smackdown, Jim Rogers did make a statement, but if you recall, the statement that Jim Rogers made was that if silver goes straight to 100, then he would be very wary about a potential overbought and then crash situation. So, as you know, silver didn't run straight to $100. It actually ran to 50 and corrected back down to what we recently had as low as 26. So actually a very healthy, nearly 50% correction, and now we're back rallying. So obviously Jim Rogers is no longer concerned about silver being overbought. But as the silver bugs remember all too well, the steep and dramatic drop in the silver price to $25 sent the weak hands to slaughter, as a series of 5 margin hikes compound the pressure of a rapidly falling market to sell into the hands of the strong. Quote, during a big correction like the one we've just gone through, a lot of weak hands get shaken out of the market, said Turk. We know that has happened because of the change in open interest and also because of the smaller volumes of late. Today the situation has reversed direction according to Turk. Silver futures are back in Contango, and Jim Rogers is talking about silver once again. Moreover, as the crisis in Europe escalates, Europe's new ECB chief, Goldman Sachs alumnus Mario Draghi, is now printing approximately 30% more than the Fed is, and the European Central Bank needs to print more and can get some needed help from the Fed, according to ZeroHedge.com. Quote, throughout history, when things have gone wrong, the central banks, print money. When they print money, you should own silver, you should own rice, you should own real assets, Rogers said in an interview with CNBC on November 23rd. Back to Turk, who said he's calculated a target for the silver price during the upcoming next leg higher by taking the April 2011 high and subtracting the September 2009 and June 2010 base price, a common and fairly successful technique applied in the use of technical analysis. Turk expects the next move higher will achieve an all-time record price for the metal. Quote, the first we have already spoken about, namely the bullish flag pattern on the weekly silver chart above. When the silver breaks out to the upside, this flag measures to a target price of around $68 to $70, Turk explained. More importantly, the jump out of the flag should happen more quickly than the $18 to $50 move we saw back in 2010 and early 2011, which took about 9 months. So then it goes on to talk about beacon equity, etc. So James Turk is predicting that the next move up will take us to the $68 to $70 range based on his analysis. So let's go back to our trend analysis on the price here, and if we get this breakout into the new trend channel, and I'm just guessing the trend channel could actually start way up here at the high and right about here and then rise from there. Now, if that's the case and we get a move, and he's predicting a move actually more rapid than this move, so we would be talking about a move continuing this line all the way up. So we're talking about a move into completely new territory. All of these trend channels, if you look back, you can see when you look back to price spikes like back when Warren Buffett made his purchase in '98 and these spikes back here. When you move to a new range and expand out, then all these trend channels become compressed and they become irrelevant. So that's what we're looking for, or we're hoping for, is a price move into a new range. The MACD is indicating that something is soon going to happen. I don't know how soon is, because this can take a long time to roll over to the upside. We thought it was occurring here, but it has fallen down and now seems to be working towards the point where it's going to break out to the upside. Hopefully we get a move to test $50 and then establish some kind of trend channel rising above $50, and at that point then we'll be able to make some further projections, and we'll talk to you next time.